S&P Global is a wonderful company. Is it a buy now? We'll perform an SPGI stock analysis like Warren Buffett, one of the greatest investors of all time. We'll reverse engineer his decision-making process to look at the most telling business numbers before we estimate not one but two fair values for S&P. Along the way, there's going to be a key bonus metric that just might be the tipping point when analyzing S&P Global for your stock portfolio. Then you're going to want to watch till the end when we give our rating. So, is SPGI a potential opportunity? Right now, S&P Global trades for $351.40 per share. Year-to-date, S&P Global is up 4%. The S&P 500, one of the index products they provide, is up 9%. In the last 5 years, S&P Global compounds at 15% annually. They beat the market over this time. In the last decade, they compound at 17.5% annually, also beating the market. When we go back before the global financial crisis, S&P has compounded at 12% annually in the last 18.5 years. They beat the market over this time. That's not all for shareholders. Right now, S&P pays a 1.02% dividend yield. This yield is added to any gains in their stock over this time. With their dividends reinvested, they beat the market even further. But the burning question is, why should we be paying close attention to S&P Global? Right now, the company trades $45 above its 52-week low. They're down $70 from their 52-week high. There's not much short interest in the business. How big is SPGI? They're a huge company, one of the top rating agencies in the United States. They have a $111 billion market cap. S&P Global provides data and benchmarks to capital and commodity market participants. In 2021, and excluding IHS Markit, the S&P ratings business was over 45% of the firm's revenue and 55% of operating income. It's the largest credit rating agency in the world. The firm's other segments include market intelligence, indexes, and Platts. Market intelligence provides desktop tools and other data solutions to investment banks, corporations, and other entities. Indexes provide benchmarks for financial markets and are monetized through subscriptions, asset-based fees, and transaction-based royalties. Platts provide benchmarks to commodity markets, principally petroleum. S&P transformed their business with the acquisition of IHS Markit for $44 billion in 2021. We'll see in our analysis that they added a lot of capital to make this acquisition happen. S&P traces its roots to McGraw-Hill Financial. It was founded in 1860 and is headquartered in the Big Apple, New York, New York. Now with that understanding, let's dive deep into their numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A normal business earns 7% returns on capital. When we look for a benchmark that's double this, we can build in margin of safety based on the quality of the business. S&P earned returns on capital above 40% in 4 of these 5 years. These came crashing down in 2022 when they only earned 7% returns. This is because of that huge IHS Markit acquisition. The company added on a lot of debt and they also issued shares, significantly increasing the capital in their business without seeing a ton of returns immediately. Because of this, their returns on capital have plummeted, although they may rise again in the future, as they added all this capital up front and then they'll continue to see returns from that investment. Still, when these are averaged out, S&P earns 37.5% returns on capital in a given year. That's more than 5 times better than a normal business. This is a huge check on metric number 1. Our second metric, we want growth to support their high returns on capital. S&P has grown organically and through their acquisitions. In this time, they've grown their revenues by 93%, their earnings are only up 20%, and their free cash flows have grown by 63%. This is growth, but it's not blockbuster growth. Still, it's a check on metric number 2. Metric number 3, we want earnings per share growth. This looks at S&P Global from the view of an individual shareholder. In this time, the company's grown their earnings by 20%. While it looks like they've grown their earnings per share, they earned $10.20 last year. In their last 12 months, they've only earned $7.22. This is because they diluted shareholders by 28%. They issued these shares for their IHS Markit acquisition. Diluting shareholders of a wonderful business is never a good idea. It's especially not great when it decreases their value on a per share basis, which is what it seems to have done here. Still, time will tell whether this acquisition added or destroyed value for shareholders. Because their earnings per share are down, this is an X on metric number 3. Metric number 4, we want free cash flow per share growth. Their free cash flows have grown by 63%, so we get a different result than their earnings per share. This free cash flow growth outpaces their 28% shareholder dilution. meaning their free cash flows are up in this time. It's a check on metric number 4. So far, we have 3 checks and 1 X through 4 metrics for S&P Global. How will the business perform in the second half of our analysis? We'll find out, but first, why don't we check in on our bonus? Right now, S&P Global pays a 1.02% dividend yield. Are their dividends safe, and can these grow in the future? S&P looks like it's a dividend growth stock. They've grown their dividends in each of the last 5 years, even after making this acquisition. During this time, the company easily supports their dividends using their cash flows, which is what we want to see. They never distribute more than a 50% dividend payout ratio. It looks like S&P Global can keep growing their dividends into the future and support these with their free cash flows. It's a check on our bonus. In recessions, it's businesses with too much debt that can have the biggest losses or even go broke. Metric number 5, we want their net debt to be supported by their free cash flows in their last 5 years. S&P Global added nearly $12 billion in debt to support their acquisition in the last year alone. Right now, they have $10.6 billion in debt, which is just slightly above where they ended 2022. In the last 5 years, when we add up their free cash flows, the company's generated $11.1 billion of free cash flow. That's just enough to support their debt position. They produced $3.2 billion of free cash flow in their last 12 months. That more easily supports this position. It's a check on metric number 5. While it's toward the upper end, it looks like S&P Global is able to produce enough free cash flow to comfortably support their debt loads. The big metric of them all, metric number 6, we want S&P's average free cash flows divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 ways we'll use their free cash flows to estimate their fair value. Right now, S&P Global has a $125 billion enterprise value. This adds up their net debt position and their market cap to look at the company like a private business. In the last 5 years, we learned they earned $11.1 billion of free cash flow. This means they bring in $2.2 billion of free cash flow in an average year. When we divide that by their enterprise value, it gives us a 1.8% average free cash flow yield. Currently, the company produced $3.2 billion of free cash flow in their last 12 months. When we divide that by their enterprise value, we get a 2.6% current free cash flow yield. These both come in below the yield from the 10-year treasury. They're down from our 5% risk premium. This means on metric number 6, it's an X for SPGI. Don't just throw this business out. We're not finished. Watch to learn what S&P's fair value per share is before you stick around for our rating. Everything we've covered so far is important, but there's something missing that in my opinion is the main reason to look at S&P Global. This takes us to use a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any field, its outputs are sensitive to its inputs. We'll start with their average free cash flows in their last few years, then use historical assumptions to grow these into the future. Keep in mind this doesn't include any synergies from their IHS Markit acquisition that can impact their fair value. If we assume they grow their free cash flows at 9.5% annually in each of the next 10 years, then in the following decade, let's assume this growth rate is cut in half and these grow at under 5% annually. We won't add in their tangible book value as that's likely skewed based on how the accounting is done for their business. S&P Global as a capital markets company is very asset light. If we want a 15% rate of return, which beats the market like what Warren Buffett's looking for, from today's valuation multiples, an estimate of S&P Global's fair value per share is only $141. That's down $210 from their current stock price. The big question is, why is this so much different than their stock price? That answer has to do with the company's multiples. Right now, they trade for a price to owner earnings of 43 times. Historically, in the last 10 years, they've traded as low as 12 times, and their median returns have been 31.5 times. They're above these historical multiples right now, pretty much across all the measures of their company. Much of this has to do with their acquisition, which hasn't shown a lot so far. Still, that could get better into the future, but no matter which way you look at it, S&P is trading for some very high multiples. Guru Focus has a higher valuation for S&P Global at around $421 per share. Keep in mind that's against some of their historical multiples, and that assumes the same level of growth into the future. While rating agencies are an oligopoly in the United States, and they're gonna do well over time, it's likely this company would feel some pain during a recession. Also, some of the valuation measures Guru Focus is looking at aren't gonna be applicable for S&P Global. Keep in mind, most importantly, this analysis is not financial advice. It isn't a buy or sell recommendation of any security. Consult with your financial advisor before you make any decision. Warren Buffett owns S&P Global's main competitor, Moody's. He cares about the numbers, but the qualities of a business are even more important to him. Let's learn what these are for SPGI. We're going to start with a long thesis. Number 1, once a benchmark is accepted by capital or commodity market participants, it's difficult to displace. As a result, S&P has strong pricing power in its ratings, index subscriptions, and Platts business. Number 2, relative to Moody's, S&P Global's business is more diversified and less sensitive to changes in bond issuance volume. The merger with IHS Markit makes earnings more annuity-like. Number 3, S&P has demonstrated strong margin expansion. Given the relatively fixed nature of the firm's cost structure, incremental revenue often flows to the bottom line. But it wouldn't be fair if we didn't cover the negatives of the company as well. Let's look at a short thesis. Number 1, a slowing global economy and rising interest rates will eventually pressure bond issuance, adversely affecting the largest profit driver, their ratings business. Number 2, the acquisition of IHS Markit poses risks. The target's businesses, while recurring, are not as moaty as S&P's legacy business. And number 3, S&P's index business has benefited greatly from the shift to passive investing, which could see limited growth going forward as index levels have reached elevated multiples. Now, let's combine their qualities with their numbers as we give a rating. So far in our analysis of S&P Global, stock ticker SPGI, we've learned they have a lot of the signs of being a wonderful company. They earn very high returns on capital, they've grown, they use a modest amount of debt in their business. However, even though they have these wonderful company signs and they have lots of pricing power in some of their moaty businesses, the company's IHS Markit acquisition does come with some risks. They added a lot of capital to their business, and they also issued a lot of shares of a potentially wonderful business to fuel this acquisition, all for the sake of more steady earnings and diversification, which in the words of Charlie Munger may serve as diversification. While the company does support a growing dividend, their free cash flow yields don't look attractive compared to the 10-year treasury. S&P Global is trading at the high end of historical multiples. When we performed our discounted cash flow analysis from today's valuations, if you believe those assumptions and you want a rate of return of 15%, which beats the market like Warren Buffett, an estimate of S&P Global's fair value per share is around $141. They last traded at those levels way back in May of 2017. Since then, they have outperformed this, but their multiples have expanded by a lot. As they integrate IHS Markit, their multiples may get more reasonable, but the company hasn't seen a lot of benefits from that yet. When we look at their qualities and their numbers together, S&P looks like an interesting candidate for more research. If you enjoyed today's SPGI stock analysis, like it, subscribe to the channel for more, and watch this next video on screen.